The Jared Dillian Show.
I'm Jared Dillian. This is The Jared Dillian Show. Welcome. We're going to be talking about your money. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is The Jared Dillian Show, and I think sort of bears repeating that the stock market is at all-time highs. Seems like every day the stock market is at all-time highs. But as a matter of fact, 8% of the time, the stock market is at all-time highs. And I think that 8% has been like the last year. So we're going to be talking about commodities. And there are people out there who say that commodities are unsuitable or shouldn't be in your portfolio. And I sort of understand the sentiment because commodities are a bit exotic. You know, when people think about trading commodities, they think of trading places. They think of the frozen concentrate orange juice pit in New York. People waving tickets, wearing trading smocks, trading floors, Chicago Mercantile Exchange, Chicago Board of Trade, that sort of thing. All that's actually, that stuff is all gone. And the physical trading floors are gone and all those jobs are gone. And it's in many ways, it's kind of a shame. Because those were entry-level jobs in the financial industry that a lot of young people would get, and that was how they worked their way up in the industry. And now there's no entry-level jobs anymore. There's no place to get your start. There's no place to get a foothold in the industry. That's how I got my start. I got my start in the P Coast Options Exchange. I was 25 years old, and I was a clerk, and I was getting sandwiches. I was getting food. I was running risk reports, and I basically was just a gopher. And I learned all about markets. I learned about options, and it was a great education. And I parlayed that into a job at Lehman Brothers. But now you can't parlay anything anymore. There's no entry level jobs. I mean, basically, if you want to work in finance, the only way you can do that now, and there's other ways, but the main way you can do that is you have to go to an Ivy League school and get recruited. And now it's a bunch of cake eaters. You know, so it's just a bunch of rich guys. It's actually if you think about how democratized the markets were before and how, you know, literally like a guy who was working a lunch counter could walk onto a trading floor and start trading and move up to a bank, and that just doesn't exist anymore. Actually, now what you have is you have math PhDs, you have rocket scientists, and these people get recruited from places like MIT and Caltech, and they're physics majors, and they're the ones that are making lots of money. I was at a dinner with a bunch of these guys out in Chicago. This was April of this year. I was sitting next to a 23-year-old kid wearing a Rolex. 23-year-old kid wearing a Rolex. Now, a Rolex is definitely not unheard of on Wall Street, but usually age 30, maybe 28. But when you're 23, and I've heard stories about how these guys, it's mostly guys, getting recruited out of places like Caltech and MIT, and how they'll make $300,000 to start. I mean, the amount of money these people make is unbelievable. I've heard other stories about. We can't get into this right now. It's insane. The amount of money that's being made, and nobody knows about it. You know, it's interesting because if you go back to the days of Liar's Poker and Michael Lewis in 1986 and Salomon Brothers and John Goodfriend and all that stuff, everybody knew Wall Street was making money. You have guys making much more money than that, and nobody knows about it. It's the guys behind the computers. Anyway, we got off on a tangent. Why have commodities in your portfolio? And I think it's important to point out the difference between commodities and securities. And a commodity is something you use. It's something you eat. It's something you burn. It's something you drop on your foot. It's a thing. A security isn't a thing. A stock is a security, and a bond is a security. Those are the main two things. And options are not securities. Options are derivatives. The value of options is derived from the value of something else. So let's talk about stocks and bonds. A security is something that has cash flow associated with it usually. Okay, so a stock pays dividends, a bond pays coupons. And they're claims on future cash flow. That's what a security is. And so the reason you don't want commodities in your portfolio, so people say, is because they're not securities. They're not claims on cash flow. They don't have any cash flows. And the only way you make money is if they go up. And, to be perfectly honest, for long periods of time, they go down. And we'll talk about this in this. I don't want to get ahead of myself. But securities are issued by governments and businesses puke out cash. And they pay interest on debt and dividends on stocks, and commodities don't have any cash flows. So why have commodities? And the answer is, I'll tell you the answer. The answer is because they are uncorrelated to other things in your portfolio. And this is, people who have never managed a portfolio don't have a good grasp on why this is important. You don't want to build a portfolio of things that all move the same direction, like a marching band. Right? Let's just say, for example, you say, I'm going to build a portfolio for retirement. Okay. And my portfolio is going to consist of 5 stocks: stock A, stock B, stock C, stock D, stock E. And they're all going to be gold mining stocks. So gold mining stock A, gold mining stock B, et cetera, et cetera. And what you will find with that portfolio of 5 gold mining stocks is that they will move like a marching band. They'll all go up together. They'll all go down together. And what they will do is they will exacerbate the volatility of that portfolio. So if you hold that portfolio, you're just going to vomit from all the volatility because everything moves together. So let's say we took gold mining stock A, let's say Newmont Mining. Okay, so we have Newmont Mining, and we added another stock to the portfolio. We have a 2-stock portfolio, and we add Apple. So we have Newmont Mining and Apple. Interestingly enough, there's very little correlation between Newmont Mining and Apple. If Newmont Mining goes up, Apple is likely to go down. And if Apple goes up, Newmont Mining is likely to go down. And what that means is this will smooth out the volatility in your portfolio, because if something is going up and something is going down, they will cancel each other out. And over the long run, they'll both increase in value. They'll both grow over time. But the day-to-day fluctuations, this volatility will be compressed, and you'll be able to, even a 2-stock portfolio of things that, just like Newmont Mining and Apple, like that would be okay. Okay. And the problem is that people construct these portfolios that are just, everything is correlated, right? I'm going to have a couple of mutual funds here. I'm going to have a tech mutual fund, and I'm going to have a growth mutual fund, and I'm going to have an S&P 500 mutual fund. So now I'm diversified. I'm totally diversified. Actually, you have all the same thing. You have all the same thing. You've built a totally uncorrelated portfolio. And, everything's been great lately. You've had volatility on the way up, but you don't really care that much if you have volatility on the way up until you have volatility on the way down. And I'm trying to explain this as simply as I can. And people do not have a really solid grasp of the risk in their portfolio. And that's what, when I see people out there, and they do exist, who recommend 100% stock portfolios, especially when they're 100% growth stock portfolios, I don't care what these things return over time. I don't care if they're supposed to return 15%. I don't care. Even if they returned more than anything else in the markets, it's a problem, because you shouldn't just care about the return. You must also care about the risk. And if you only care about the return and you don't care about the risk, then you are a simpleton. Then you're an absolute simpleton. So, like I said, there are people out there who do that, and it's risk and return. Those are the 2 parts of the equation, and people are just being taught one part of the equation. They're just taught the return part, and they're taught to chase the highest returns possible. And, it's worked out so far. We'll see how they feel next time we have a downturn. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.